Sneakflation is a term that, hey, you know what? Next year, when all the tariff stuff kind of calms down, the microscope isn't on them, they start to raise prices, these corporations, on things that are not tariffed or not from tariff nations, expanding our money supply because the Fed has been restricted. I'm going to explain that. Credit card loans, car loans, those are short-term borrowing rates, and they are low right now. Microsoft and Google came out and said, we're not going to reduce our billions of dollars of spending. Existing home sales, 4 million home sales annual rate. That's with a little drop. Hey, it's KP coming to you live from Corona, California. Take 2 on my video. The audio was horrendous. You can see this is a real office. That's real scenery out there. There was even a bird flying in my last one. Lots going on. There was another war started, although some may say that war between Israel and Iran has been raging for, I don't know, a few thousand years, and how it impacted our markets. I had a couple of videos I put out last week. A few videos back, I talked about $80 oil, and I'll talk about the flight to safety trade, how $80 oil is way more harmful for our inflation and GDP than the threat and uncertainty of tariffs. And I'll put the math to both of it. And I'm going to introduce you a term, if you have not heard yet, sneakflation. What is sneakflation? We'll get into that in just a second. Okay, so it is Fed week. Huge meeting coming up on Wednesday. And, of course, the G7 economies are in Alberta province. Okay, that's like, not all the way over to Vancouver on the western side, but it's like the Texas, like the Texas of Canada, right? A lot of oil producers there. Got some good friends, my buddy Jeff and Chris Jones. They're 4 kids. They're from Fort McMurray. And so it's very interesting that they're up there because they're talking about trade. They're talking about doing business. They're talking about oil and gas in light of the Israeli airstrikes on Iran and then vice versa in the retaliation. And they're also talking about tariff uncertainty. So my guess is that when Chair Powell has his press conference on Wednesday and the dot plot, the summary of economic projections, when they only put out, one cut this year or maybe a little less than the last dot plot said, maybe it still says 2, but like a soft 2, that would obviously roil the markets and make the markets go up. There's not going to be Fed cutting or quantitative easing or cheap money flowing into the economy to stave off all the fears we have from uncertainty of tariffs, stagflation, and hellfire raining down upon the skies and the beginning of World War III and all that stuff. But my guess is President Trump will probably want to upstage Chair Powell and announce some good news that came out of the G7 summit. So I don't know, maybe they'll get some framework announced for some deals that are being cut. Last Thursday, I put out a video in a couple different places talking about the flight to safety trade, the flight to quality trade, right? So when there's, let's say, like during a pandemic, pretty clear. Okay, things are getting scary. The world might be shutting down. What's going on here? Money flows out of the stock market, okay, because you put money in stocks, equities, to risk making money. You put money into bonds, treasuries, mortgage-backed securities, whatever, treasuries, not to lose money. And typically money flows out of the stock market into bonds. Now, this was like the most, I'll get into the Pentagon Pizza Index, but this was like the most hey, look what we're doing. We're about to attack Iran, just letting everyone know. I was seeing posts about, U.S. personnel being taken out of embassies in the Middle East and telling everyone to go catch cover. And there's even a Pentagon Pizza Index. You could literally go on your Google app and you could see that at 9 p.m. East Coast time in D.C., like the wait time was extremely higher than normal to order a pizza. That means everyone at the Pentagon is ordering a pizza because they got a long night ahead of them to watch all these airstrikes happen overnight. I am not a financial advisor. I'm not responsible for your losses, only your profits. I did buy a put trade. I bought some S&P puts. That's basically betting that the stock market would sell off. Now, typically the stock market, money flows out of stocks into bonds or out of bonds into stocks. It's kind of doesn't always happen like that every single day. Overnight, that trade was up like 100%, like a little double my money, and ended up only being up 20% in the morning because all the institutional traders, they have different, they don't pull out their phone and do a trade on Interactive Broker or Robinhood or whatever, they trade in dark pools, exchanges that institutional traders trade in. They're trading billions of dollars. I'm trading like way less, trust me. So the thesis was right. And so before the stock market opened, not only did the stock market calm down a little bit and not sell off as much, and the bond market did not have its rally because of the flight to safety, because oil went up. And the threat of oil prices going up is a threat to GDP and inflation, way more than tariffs. And I'll give you the math. So remember, I gave you some math a few weeks ago on all this tariff uncertainty. So remember, for tariffs, each 1% increase in the effective tariff rate, just 1%, okay? We've been at 3, let's call it 3 just for safe math, during the Biden years, 3%. If we go to this 10% baseline thing, that's a 7-point increase, okay? So for every 1 point, it only drags GDP by 0.14%, right? So, 7 times 0.14%, let's just call it a full, point, okay? So it will boost inflation by 0.09. So let's call that 0.1. So 7, it's like 0.7 up on inflation, which, by the way, inflation is like nothing. Like, it's absolutely nothing right now. Other than housing and auto insurance, I mean, goods were literally negative in the last print. I know someday it's going to come across on a ship, and then we'll all be forced with a gun on our head to pay for all this expensive stuff from all these nations, and then it will be the drag on inflation, and then the job losses will come, and then stagflation. I'll get into the sneakflation. Why sneakflation is a solution to avoid stagflation. I'll get in a second. But the math for oil, a sustained $10 increase in the price per barrel of oil, okay? We've been like around $65 for quite some time. Spiked up to like $79 last week. Now it's back down in the 60s. So it was a big nothing burger. Everything was a big nothing burger. Stock market rallied today. Bonds actually went up the last couple of days. You know what? They caught a bid for all the inflation prints that were coming up to it. So for every $10 sustained, so let's say we're at $75, okay, price sustained, okay, inflation would increase by 0.4%, not 0.09, 0.4, 40 basis points, and GDP would lower by 0.4%. compared to the tariff math of 0.14%. So 0.14% GDP on tariffs, 0.09% inflation boost from tariffs, which are completely uncertain. We have no idea. No one really knows. And sneakflation is a way to defend that. But with sustained oil prices, which lower oil costs have been a big driver of these CPI and PCE numbers being down, $10 sustained price increase is 0.4 and 0.4 on inflation and GDP. Way more impactful. But I digress. It's all kind of gone. Hopefully they resolve all that. Hopefully there's some peace that gets done. Inflation is supply chain driven. So it's like we saw during the pandemic. Like it was, it wasn't like this overwhelming, demand. It was that the supply couldn't meet up with just basic demand. And the tariff uncertainty has potentially rattled supply chains. Hasn't yet. It might. I don't know. But ironically, in the last, which by the way, the biggest driver of inflation is this big, beautiful bill, which news came out of the Senate today. They sent out some text in their reconciliation to send back to the House. They did not want to do the $40,000 SALT tax deduction increase. They want to keep it at 10. They want to do deeper cuts on Medicaid. Remember, there's only 2 people from New York and 2 people from California in the Senate. And so, in the House, there's both Republicans and Democrats from California and New York. And so those Republican votes are needed to help pass the bill. And so when a California and New York Republican House representative asks for something, they mean it, they need it, and they may not give their vote, which would make it more difficult to pass in the House. When it goes to the Senate, they're like, yeah, you know what, we got a majority, and both senators from those states are Democrats. So we don't really care what you have to say, so we're going to reduce this and this. So they're making the sausage. They got 4 weeks on their self-imposed deadline of July 4th. We'll see how that goes. But that's breaking news. It came out just a little while ago from the Senate. So you can check on that. Okay, so inflation's falling like a rock. The Fed is meeting this week. Retail sales numbers out tomorrow. And retail sales, GDP in this country is 70% consumer-driven. So what is sneakflation? The 9-minute tease on what sneakflation is. So in the last administration, you heard a lot, and you always hear a lot. Like, for example, I'll take an extreme example. Senator Elizabeth Warren. Like, she just hates millionaires and billionaires, although I think she's a millionaire. And you know, they need to pay their fair share. Now, ironically, the tariffs impose consumption tax, which right now billionaire corporations are eating those costs. Let's take Walmart, for example, okay? Out of good old Arkansas. They even went into DC and they said, hey, we are going to eat this. We're going to eat as much of these, you know, input cost increases as we can. There is absolutely a microscope on every corporation for the items that they get that are taxed or tariffed, which is essentially a tax. They are eating that in their profit, okay? And so far, the prices passed along have been eaten by billionaire corporations. So they're assuming that. Sneakflation is a term that, hey, you know what? Next year, when all the tariff stuff kind of calms down, the microscope isn't on them, they start to raise prices, these corporations, on things that are not tariffed or not from tariff nations. So maybe on something that's made domestically, but, you know, they could use a little more profit margin because they're eating it over here. They'll raise it up over here. Sneak it in on us. Sneakflation. So that's what I'm hearing. The irony abounds. You know, it is what it is. So obviously this meeting coming out is super important from the Fed, and the dot plot is a big deal. And I will add that, you know, they're not going to cut this meeting, but if they say they're coming down to less than 2, maybe 1-ish, the bias is still to cut. They may offset that dot plot by pulling forward 2026 cuts and saying there's going to be more of them. So is it enough to offset the anxiety of this stock market, for example, which would probably sell off if that is deemed as hawkish commentary and dot plot, that would be seen you know, as equity unfriendly. Now we have Chile, Japan, Brazil, Sweden, England, Switzerland. All their central banks are meeting this week. I got this straight from the Chrisman commentary. Rob Chrisman himself, and of course the cap markets section that Robbie writes. And 2 of those banks are expected to cut rates by 25 basis points. So the bias is for all the central banks to continue to cut because this is what a soft landing looks like. Soft landing meaning there is no recession. So remember, every time we have rate hikes, we go into recession. And it's never not happened, right, eventually. And so the Fed has notoriously never been able to engineer a soft landing. A soft landing meaning no recession. Well, they've been raising rates since, March of, 2023? We've had higher mortgage interest rates that went all the way up in June of 22, 3 years ago, this month. I think they peaked in the fall of 22. Housing's been kind of a rolling recession. Although 23 was better than 22, 24 was better, 25 is better, and the rates have stayed pretty much in a range. Manufacturing, rolling recession, but no outright recession. So we have been in a soft landing, which is what the data has said, and that's what matters more than your feelings. So data is what matters more than anything. You know what else is market friendly? So even if, you know, we don't have any cuts, there's a ton of innovation. There's like $1 trillion committed to come into the United States and build infrastructure. I'll give you an example. So OpenAI is 4 times larger than Google in terms of its IPO for revenue and searches. They just had $10 billion in revenue. I mean, AI is extremely fast, and it is. I know it's hard to think. It blows my mind some of the stuff I'm seeing and reading about. But AI today is not. It's not like, you know, Barry Habib used to do this really great post where he showed like the patent office guy from like 1891, like, all right, the U.S. patent office is closed because everything that will ever be invented has been invented. AI is in an infinite race, and where it will be in a year, 3 or 5 years will absolutely be completely underestimated, and we have no idea how good it's going to get, and it's going to get incredible. CapEx is huge. People are spending tremendous amounts on AI infrastructure, data centers, power to generate those data centers. I mean, nations that create more power lead in GDP. And, you know, I'll leave you one last thing here. Very interesting screenshot that I took. And just, it was like this, one of my stock subscription services that showed all the AI investment that's going on right now. Okay, just in logistics: Amazon, Walmart, DHL, FedEx. Manufacturing: Tesla, think autonomous, Optimus, their robot. BMW, Ford, Mercedes, Toyota, Foxconn, Apple's manufacturer. Xenex in hospitality and health. Agriculture: Deere and Company. They're selling autonomous tractors that can plow fields without a human driver. I could go on and on about everything that's going on, but it is happening. It's real. It's not going away. And, a little housing news, the NBA, I got Rob Crispin and I got Bob Brooksmith, the two most traveled guys in that order. A Minute with Bob, you could check it out in the NBA newsroom. They are floating the idea of a single merge credit report. They looked at 2 million tri-merges, took the highest score every time, and saw the difference between the three by if it was trying to be gamed in the system by picking the highest one. It was only like 7, 10, 12 points. So maybe the single merge is the solution for all this extremely high cost-worthy stuff. Cheers.
Hey, it's KP coming to you live from the Wedge in Newport Beach. It's this famous, beautiful wedge right here. You see where the beach and this rock jetty come together, creates a double up. And it's a very famous wave. Someone dies there like once every 2 or 3 years. A little crazy. We got Corte de Mar State Park over here. That's CDM. Those palm trees over there. That's-Goldenrod, my good buddy Martin Warren, who I hope to see tonight. Formation Direct lives there. And you've got Pelican Hill, Laguna, Passat, Dana Point. And here we are pulling into the harbor after our retail regional leadership retreat. Just a quick little 2 days to Catalina Island and back. And it's absolutely gorgeous. We've got Little China Beach right here. It's a very famous little secret beach. Okay, Fed Day, big day. After retail sales number came out. And remember, I'm going to break it all down. I'm going to try and be super quick. Famous last words. By the way, about to get hit by a sailboat. Let's go. So retail sales was disappointing. Our economy is 70% GDP. 70% of our GDP is consumer spending. So when retail sales is down in the month of May, does that mean tariff effect hasn't come through yet? Or consumers decided with a gun to their head not to buy more expensive stuff like they always do? I mean, they're not going to buy beyond their means, right? Especially with maxed out credit cards. So anyway, negative 0.9% down on retail sales for the month of May. Now, they have this like Supercore or core reading for retail sales. They strip out autos, which are very volatile. They strip out gas and like some other inputs. And the number was actually up 0.4% in the month of May versus estimate of 0.3. So that was seen as a sign of strength in retail sales, even though the overall number is down. So what does a data-dependent Fed to do? What are they to do? Well, they're not data-dependent. They're trying to predict the future. And they've been trying to predict the future because the tariff conversation, stagflation, sneakflation, all these flations have entered the conversation. And the reality is the Fed doesn't know. They never know. They just don't know the future. And it's interesting, we had our dot plot today, and that's where they have to show their cards. There's a very interesting quote I read from Neil Kashkari, who's the Minnesota Fed governor. And he basically said, when we put a dot down, it just says a number, but it doesn't say how we feel or how confident we are in what we put down, but we got to put down. And so I thought that was an interesting take. But so what? Screw their feelings, put the dot down, and we'll deal with what we got. The dots are wildly inaccurate. Like I've said before, some of my subscription services have said they have no idea what they're doing. They cannot predict the future, and they're largely wrong. So what's the recap on the dot plot, since they do it every 12 weeks, every other meeting? What did it say? Lower GDP this year. I think they said they're going to have 1.4% GDP, down from 1.7, 4.5% unemployment rate. That's up from last March's dot plot at 4.4, which was also up from December's 4.2. And we're at 4.2 now. So what do they say about Fed rate cuts? 7 of the 19 dots said no cuts this year. But the majority of the cuts in the dots said there will still be 2 rate cuts. Now, Nick Timiraos, the Fed whisperer on the Wall Street Journal, literally the only reason to read the Wall Street Journal is to get his take on things, because he does have some really good insights. He reminded us that a year ago in June, the dot plot said there would be 1 cut in this year, the year of 2024 at that time. And then 2 meetings later in September, boom, 50 basis points, and then another 25, then another 25. They don't know. So they're not really data dependent. They're trying to predict the future with the tariff uncertainty, and there is still uncertainty. We have no idea what it's going to be. I mean, tomorrow we could have more tariff bombs, the 90-day reprieve. There could be more government spending surprises in the big, beautiful bill. There's a lot that is uncertain. So the Fed's just going to punish everybody with higher interests. Our third biggest payment on the debt. Our debt is our interest payments. And they're going to punish you and me on higher credit card rates, car loan rates. So you know what that means? We just don't have to take out new debt, which means we don't grow as much because the rates are high and we have that choice. I'd like to buy a new car. I don't need a new car. And so I'm just going to keep ragging out the old beaters that I have that are 6 years old. I have one that's 21 years old, which is going to keep on using that truck until it dies. So the dot plot's out. They don't really mean a lot, but they're great to talk about. I love talking about it. But what matters is the flow of money. And the bond auctions have been somewhat decent lately. There's, obviously heavy amount of Treasury issuance. About 25% of all the Treasuries out there in the world have to be reissued. Let's call it within the next year, mostly by the end of this year, when they were initially issued in 2020 when rates were low. And of course, our very thoughtful Treasury Department decided instead of buying 30-year long bonds at historically low rates, that they would do short-term rates like 5-year bonds and 2-year bonds. Do I sound sarcastic? Because literally, when you had the lowest rates in the history of history, they didn't do the 30-year fixed rate. They're like, let's do an ARM. Anyway, so we have to deal with that this year, especially with the one big beautiful bill. And it's kind of ridiculous. And it does put upward pressure on Treasury yields. And, I want to debunk this theory about China and Japan and all these foreign holders. China holds less than 3% of the world's treasuries. And they're actually up this year versus last year on their holdings. Japan, they're holding pretty steady. They're the largest foreign buyer at 1.25 trillion. But still, there are so many other players, mostly institutional investors that are domestic in the U.S. So the flow of money continues. It continues to be good and decent till it isn't. If we have slowing GDP, rising inflation, and higher unemployment, that's stagflation. But is it a recession? Because if we're in a recession or have a recession, which we haven't had since COVID, then there is a soft landing. So you can't have a soft landing forever. So we are cyclical. At some point there will be a recession, which by the way is extremely good for the mortgage industry and real estate agents because rates tend to come down quite a bit. So not praying for that, but there's always a silver lining. So let's keep grinding. Hopefully I got out a lot of information. I'll leave it one last tidbit, very interesting. So AI, we talk about all the time. AI is here. It's here. It's being worked on, not just in our business, but everywhere. You guys know I drive a 6-year-old Tesla that's been driving me home, saving my life after a couple cocktails on autopilot, full self-driving for years. So not encouraging that behavior, by the way. But what I will say is that OpenAI, Meta, and Palantir all have had lieutenant colonels sworn in as officers in the Army Reserve. That's how prevalent AI is today in our military, and it's expanding, and it's not going to slow down. So here's one last beautiful look at the harbor. I apologize if it's too windy. Usually my AirPods do a good job of blocking it out. It just seemed kind of windy. This is Fashion Island over there. The home of Pinco and Chipotle. I think Pacific Life is over there. Here's the other side, this peninsula. So all the kids out there in junior guards, like my 10 and 12-year-old daughters and all the other kids out there doing lifeguard training. It's all going on. Summer has sprung. The 20th, 2 days from now, is the longest day of the year. So this is the brightest spot of 25. The days will get shorter and darker from there. And hopefully, the U.S. doesn't drag us into a prolonged war in Iran. Speaking of darker times, hoping that whatever's going on over there, that Israel ends it quickly on their own. Maybe they need our bunker busters. Maybe there's a deal that comes to the table. Maybe we get some peace, in the Middle East. Israel, Iran, Hamas, Ukraine, Russia. Pray for peace. Pray for a fun summer, safe summer. We'll get back to you next week. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.